All right. Today is Thursday, August 19th. This is a recap for the stock market activities today. I got a good one for you, per usual. So let's go ahead and start right away. In focus tonight, we will discuss the disgusting market manipulation efforts that have been going on throughout the week. And then we'll talk about good news versus bad news, how to read good news and bad news when it comes to tapering. And I'll take you back to school in this one. And lastly, we're going to talk about this piece of shit, Neel CASHkari, because he said some important things today regarding tapering. Let's start with market manipulation via you-know-who, the head of the Federal Reserve, Jerome Powell. Powell sits all day on the computer screen with the Bloomberg terminal, by the way, in front of him, and he sits all day watching the stock market tick by tick with a big jar of lotion next to him, jerking off to every green candle. But when a red candle happens, whoop, what is that? What is it, a red candle? Unacceptable. And you see these disgusting market manipulation efforts, algorithmically of course. And this week so far, I have seen some of the biggest green candles from an intraday perspective that I have ever seen before. Every time there is a sell-off and we see the market flushing down, immediately there is a response, algorithmic response, pushing the market higher with such aggressiveness and ferocity to prop up the stock market. Why are they doing this specifically this week? The answer is they're starting to hint to an announcement of tapering, and the Fed is extremely worried that the market will suffer another taper tantrum. We see a sell-off in the stock market which will result in a backlash against the Fed. Rest assured, folks, tapering is not going to do anything to the market. There is nothing to see here. Tapering will be good for the stock market. Stop selling your stocks. Stop panicking. We got your back. Trust us. And of course, these days you have these imbeciles, the apes, the Wall Street bets and the likes, complaining all day long about the market manipulation efforts by the hedgies and the shorties and the dark pools, yada, yada, yada. But they never bother complaining about the market manipulation that has been going on for over a decade now, enriching Wall Street and the rich in the process, and enlarging the income and wealth inequality gap in America. You see, since the last financial crisis of 2008-2009, the Fed has implemented quote-unquote emergency measures to prop up the stock market and the economy. These same emergency measures are still here. It has been over a decade ago since the last financial crisis. Meanwhile, the so-called accommodative measures, the emergency measures, are still here. Why? You could say COVID, but those emergency measures have been going on even in 2017, 2018, 2019, when we had a hot economy. We reached the lowest unemployment rate in modern history, and yet the Fed continued their so-called emergency measures, their so-called accommodative measures, because the moment in 2018, if you remember, the moment the Fed announced that they will start raising interest rates and moving away from the so-called accommodative measures, aka the cocaine operation, which has been injected to the market for the last decade. The moment the Fed announced that they will start raising interest rates and moving from easing to tightening, the market crashed right away, instantly. And the market did not stop crashing until the Fed came out and said, you know what? We're not going to do anything about it. Forget it. We're not going to raise interest rates. We're going to go back to the good old cocaine operation. And of course, the market rallied right away, and it continued to make record highs after record highs after record highs. Nobody's complaining about that. These retail investors, the apes, the Wall Street bettors and the likes, complaining about market manipulations by the shorts, but they never talk about the market manipulation that's been going on for over 10 years by the Fed. Mind you, the stock buybacks, what do you think that is? It is Wall Street corporate executives using fake cash printed out of thin air from the Fed to buy back their shares and pump their stocks higher. Why? To reward themselves and their shareholders. They pop the stock higher and they dump right away, getting richer in the process, regardless of any price discovery, valuations, Nothing matters anymore. They use the fake cash, the cocaine, they pump the stocks higher, dump at elevated prices, way divorced from reality, and they get richer in the process. Meanwhile, they tell you and I they have the audacity of saying, hey, you bums, you gotta work a little harder if you want to make it in America. The American dream is not that easy. If you're working construction, you gotta drill a little harder. Hold that drill and give it a little oomph, and you'll make more money and you'll live comfortably. We all know this is bullshit. This whole work hard, follow the rules, that's all garbage. This is all propaganda to keep us obedient workers for Wall Street and the rich to make them richer. But these days, we're not village people anymore, and we know that the rich has been getting richer, billions and billions of dollars, not by working hard, by the way, or innovating or anything relating to economic expansion. They sit in their asses all day long watching the stock market using fake money printed out of thin air, which is, by the way, racked up as debt for the next generation. They use that money to prop up their stocks and dump them at higher prices, getting richer in the process. All done digitally while sitting on their asses. This whole Ponzi scheme, this whole garbage, fake economy has been going on for years and years and years. So when you say, hey bro, you're questioning the integrity of our markets. Yes, I am. You and I know these are manipulated markets. They're garbage markets. And therefore, in this channel, the purpose of this channel is to encourage retail investors, regular people, to wake up and realize that this propaganda of work hard, follow the rules, get a promotion, and you're going to achieve financial independence at some point. Garbage. Look at the gap between wages and home prices. We have the least home affordability in any modern nation. Once you realize that the system is broken and all of what we're doing is being obedient workers, working our asses off, wasting our time, our lives to make somebody else richer, the 1% and the Wall Streeters. But how about we rebel and we join the so-called game and we play with the same rules they have? The problem is some of us are dummies, the retail investors, and we chase meme stocks and garbage pumps and dumps, and all of what we do is contribute even more in making the rich richer and the poor poorer. You chase the mania, the pumps and dumps, guess what? You lose money at the end of the day. They get richer, and we look back, and all of what we have achieved is another cycle of boom and bust where Wall Street gets richer, just like the 2000 dot-com bubble in the 1990s ended in 2000. The message is, we have to play the same game that Wall Street has been playing for years, but we have to do it intelligently. Buy when they buy, sell when they sell. But now the so-called game is changing, and the reason is, we have inflation in the picture. It's a weird phenomenon to have inflation hand in hand with an economic disaster from the pandemic. Of course, all of this is masked by stimmies and free cash printed out of thin air. But behind the facade, we have a zombified economy that has no legs to stand on its own at all without the so-called accommodative policy. And the so-called accommodative policy will have to be removed if inflation continues to rise higher. That leads us to the main event this week, which is the anticipation of tapering. Tapering is the first major step in removing the so-called accommodative policy. Of course, they're not going to be able to remove the entire accommodative policy all at once. It has to be done gradually and getting the feedback from the economy and the market before proceeding to the next step. Of course, the ultimate step is raising interest rates. We know this will not happen anytime soon, and the reason is we have a zombified economy drowned in debt. And the moment you raise interest rates, you're going to nuke the entire economy. Game over. But step number one is tapering. The Fed says we're going to announce tapering in September, but many market observers and participants cast doubt on the Fed's ability to taper as soon as September or even October, and therefore we continue to see dip buying in the market combined with the manipulation efforts from the Fed, and we see these explosive rebounds higher pretty much every single day. Now, how do we approach reading the tapering announcement? Let's go back to school. We have new subscribers in this channel. Some of them are new investors in the market. Here's a guideline on how to read the news every single day. Remember, the market doesn't care about anything at all beside the cocaine out of the Fed. The market cares not about pandemics, COVID cases, natural disasters, nuclear wars, alien invasions, asteroids hitting the planet, the extension of humanity. So long as the cocaine continues to flow into the market digitally, the market will continue to go higher. But if there is something that will interrupt the flow of cocaine, then we have a problem. And therefore, bad news is good news for the market. Meanwhile, good news is bad news for the market. What does that mean? Here's an example. Today, we got the unemployment claims, and we had the lowest level, the lowest number of unemployment claims since the pandemic started. Is this good news or is it bad news? The answer is it is good news, but for the market, it's bad news. Why? Because if the picture of unemployment is getting better in the economy, then the market will require less and less quote-unquote accommodation by the Fed, aka removing some of the cocaine, which opens the possibility of a withdrawal syndrome in the market, since the market has been a coke addict for the last 10 years plus. Now, here's another piece of news. This is the exercise, by the way. In the classroom right now, we have the headline about COVID-19 cases, and the hospitalization is reaching levels that we have not seen since February. At the height of the pandemic, mind you. Is this bad news or good news? The answer is it's bad news. People are getting sick, people are dying, you know the story. But for the market, it's good news. It's the best news ever. And therefore the Fed, their allies, and market bulls are cheering Delta, Delta, Delta. Please kill more people so our stocks can go higher. Because you see, bad news such as more infections, more slowdown of the economy, people getting afraid of getting infected, and therefore slowing down spending, slowing down inflation, slowing down the pace of economic recovery. What does that mean? It means that the accommodative policy will be here to stay. The market has an excuse to the Fed, for the Fed. We need the cocaine. Look at Delta, bro. Look at all the problems, from shutdowns in Asia to hospitalizations in the United States rising. Come on, we need more coke. Otherwise, the market will crash. And therefore, bad news is good news for the market. This is the ongoing debate for now, and what will move the market up or down. And therefore, you have to understand it. The Fed says we're going to taper in October, and the announcement will happen in September in Jackson Hole. But will they do that really? Who knows? Either you take them at their word, and this means you're going to lighten up in your stock market portfolio, taking profits, preparing for the exit. Or you're going to call the bluff and say, you know what? The Fed will never taper. There is no way they're going to remove the coke out of the market. And therefore, I'm going to buy the dip, every single dip, aggressively. We will see which argument eventually will win. But it all depends on Fed presidents and the decisions they're about to make. One of them is Neel CASHkari out of the Minneapolis Fed Bank. And Neel CASHkari came out today and said, you know what? This whole thing with Delta, that matters a lot to me in making the tapering decision. In other words, I'm not sure about tapering, by the way, because Delta, if it continues to get worse, then perhaps I'm not going to go with tapering. So Neel CASHkari is cheering Delta, Delta, Delta. And of course, this was welcomed news by the market. The reason is we have a Fed president whose voice matter saying, I'm not sure about this tapering thing. We gotta wait and see what happens with Delta. This is exactly what the market wants, kicking the can down the road. And Neel says the entire purpose behind the coke operation by the Fed is full employment, which is bullshit. It has never been about employment, Neel. This is the excuse to continue to prop up the stock market and the real estate market, aka the assets of the wealthy, which is your real mandate, by the way. The whole employment thing is a sideshow. In other words, we're not going to stop pushing coke into the market until we reach full employment in the economy. Now, what is full employment, by the way? Well, the Fed chairman says it's a fluid situation when it comes to full employment. It could mean 2.5% rate of unemployment, but you also have to factor in other age groups, genders, minority groups, etc. So there is no clear definition when it comes to full employment. The vague nature of full employment gives the Fed the excuse to continue on and on and on with propping up the stock market via the cocaine operation. You know who had full employment, Neil? It's the guy with the funny mustache, the German guy. Actually, he was Austrian and then became German. You know the guy I'm talking about, right? Not this guy, but the guy he played on TV before. He played him in a movie. You guys know the guy I'm talking about, right? The guy we can't say his name or show pictures of him. Otherwise, God forbid, YouTube might ban the channel. You know the guy, right?
Easy. Oh. I thought it was the old German.
Right? No, it's not.
And while we're at it, let's talk about this creature, Neel CASHkari. Remember Neel, the infinite cash, Neel?
To the person who is about to grab their car keys and go to the ATM and take out $3,000, you say what?
You don't need to. Your ATM is safe. Your banks are safe. There's enough cash in the financial system. And there is an infinite amount of cash at the Federal Reserve. An infinite amount of cash at the Federal Reserve. An infinite amount of cash at the Federal Reserve. An infinite amount of cash at the Federal Reserve.
Well, Neel claims that he understands the plight of the poor, poverty in the country, homelessness. He understands all of that because he played a homeless guy on TV for about a week. Of course, with a film crew, private security, etc., etc. But now he understands. He knows how the poor in this country are suffering. And he has the solution. The solution is to push even more coke into the equities and real estate markets to prop up the assets of the wealthy, the 1%, and then some of that will trickle down to create jobs for the bums, the poories, and the homeless people and the likes. It's a psycho, sinister way of thinking. It's like saying, hey, colonialism was good because, yes, certain nations were occupied, treated as second-class citizens, but hey, we created some jobs for them to make us richer. Come on, there are some benefits to colonialism, you know, and Neel has been holding on this sort of mentality and way of thinking going back all the way to the financial crisis in '09. Listen to him justifying bailing out using taxpayer money to bail out Wall Street firms, the likes of Bear Stearns and other firms responsible for creating the crash and harming the economy, the poor, and the middle class alike.
And it's known publicly that, we offered a perspective that if the government had to step in to help stabilize Bear Stearns, that the Bear Stearns shareholders should not be rewarded for that, specifically because of the moral hazard issue. So something that we've been aware of the entire time. At the end of the day, though, the test is the cost of action more or less than the cost of inaction? And when the cost of inaction is potentially so damaging to our economy and to every American citizen, then it's an easy decision to make, even if it's an unpleasant decision to make.
So Neel says it is an unpleasant decision, but it is needed because letting these Wall Street firms collapse, they're too big to fail. So yes, they gambled, they engaged in reckless behavior, destroying the economy and themselves. But we have to bail them out. We have to take taxpayer money to bail them out. It's an unpleasant decision, but it is needed because when you think about it, when these companies go down, everybody will get hurt too. And therefore, there is a buffer. There is a safety net for Wall Street firms to continue to engage in reckless behavior and risk-taking because they know that as long as guys like Neel CASHkari in charge, they have a sugar daddy that will bail them out all the time. They will use taxpayer money, robbing and stealing from the new generation, the next generation, to bail out Wall Street firms that have engaged in bad behavior. And he is using the same logic, by the way, to justify the so-called quantitative easing, the so-called accommodative policy, the so-called cocaine operation to prop up stocks and real estate values. He uses the same logic to justify the unjustifiable.
In our conversation, CASHkari was quick to dispute the criticism that the Fed is really just boosting financial markets and helping Wall Street.
There is this idea on Wall Street that the Fed kind of has our back, and that because you may have well-intentioned policies that are trying to get everybody to work, there is this side effect, this unintended side effect of just kind of really helping the rich.
That argument ignores the benefit to the poor. And if you're going to ignore the benefit to the poor, then we're only helping the rich. But of course, that's an incomplete analysis. When you actually sit down and say, well, let's go through the trade-offs of the choices that the Fed has, whether it's interest rates or it's quantitative easing, it's not just about Wall Street. It's not just about asset prices. It's also about thinking about the men and women in America who are trying to find work and who want to have higher earnings and who deserve higher earnings. If we are benefiting them by helping them find work and helping them have higher wages, I will take that trade-off.
So Neel says it's a trade-off. For us to create jobs, we have to make the rich richer. And if you turn a blind eye to that and look at the glass half full, you can see that we have created jobs. And now these poor and middle-class people have jobs and they can join the game. Remember the game from Boystick? Here's the problem. Show me one shred of evidence, Mr. CASHkari, that the cocaine operation resulted in creating jobs. Any direct correlation that the money being printed out of thin air, showering Wall Street, and corporations, show me how that's translate into jobs. It used to be, but now the majority of money is being used for share buybacks to make executives and shareholders richer. And is this, by the way, the best way to create jobs, Mr. CASHkari? Or perhaps we have other ways to create jobs, like a free market, for example, without rocking trillions and trillions of dollars of debt. And by the way, what happened, Neel? What happened when you did your publicity stunt pretending to be a homeless guy looking for a job?
California GOP gubernatorial candidate Neel CASHkari took his campaign to the streets of Fresno by living as a homeless person for a week to highlight poverty. The Times reports that the move by the multi-millionaire Laguna Beach resident who ran the federal government's Wall Street bank bailout is intended to show the struggles facing many Californians despite improvements to the state's economy. CASHkari says he took a Greyhound bus from LA to Fresno with just $40, a backpack, some clothes, and a toothbrush. His objective was to find a job. The former U.S. Treasury official was accompanied by two videographers who filmed a 10-minute YouTube video on his experience. CASHkari says he slept on park benches and ate meals at a homeless shelter. He says it was one of the hardest weeks of his life, and in the end, he wasn't able to find work.
So here it is, total jerk-off. He pretended to be homeless, looking for a job, and he could not even find one. So much for the Fed's policy helping the poor to find jobs. But let's take Neel CASHkari's words at face value. The Fed's policies are helping recovering jobs. We had the biggest pandemic in over a century. We've lost millions and millions and millions of jobs. And Neel would say, without us, without our cocaine operation, we would have never recovered any of these jobs. We would be in a depression right now. Okay, no problem. I will ignore the fact that the recovery of jobs has a correlation with the reopening of the economy and vaccination rates. I will turn a blind eye on that one, and I will take you at face value that creating jobs, all of these jobs we're recovering right now, are due to the Fed's policy. Haven't we recovered enough jobs, Mr. CASHkari? Isn't it time to start removing some of these accommodative measures?
Just been tied up here talking about this big surprise of a number. I know you haven't had a chance to digest all of this, but does it tell you anything?
Well, I mean, I think it confirms that I feel very good about our policy approach, which is outcome-based monetary policy, which is let's actually allow the labor market to recover. Let's not just forecast that it's going to recover. Let's actually allow the labor market to recover, get back to what we call maximum employment, and get back to 2% inflation, and then we'd be in a position to talk about normalizing monetary policy. So as Chair Powell said a week ago, we've had one great jobs report. Let's not declare victory yet. Let's let the labor market heal, and then we can move from there.
By the way, this was back in April, the April non-farm payroll report, which came out way harder than expectations. And Neel said, you know what, yes, it is a good report, but it doesn't merit us removing the accommodative measures out of the market because we need to see consistency in the pace of jobs recovery. We need to see more reports like this one. Let's not rush and let's give the economy the time to heal. Okay, what do you say now, Neel? Fast forward that we have over 10 million jobs available right now. 10 million jobs, but they're not being filled. So what do you say, Neel? Perhaps more Coke will motivate all of these people staying at home right now to go out and take these jobs. Just a little more Coke for the stock and real estate markets. What are you waiting for, Neel? We have already achieved full employment. We have over 10 million jobs available. They're not being filled by employers because employees, potential employees, are choosing to stay at home. And the Fed's policy for injecting Coke into the market has nothing to do at all with the pace of recovering all of these jobs lost, creating new jobs, or even motivating employees to fill the jobs that are already available. Now, we have many reasons behind employees choosing to sit at home and not filling all of these jobs available. Among them, the fear of COVID, other alternatives, family obligations, specifically for moms, low wages, retirement, employees choosing to take a year off, and also the stimulus, the unemployment benefits, the $300 a week from the federal government. This is also creating an environment where many workers choosing to stay at home, receiving those unemployment checks, and not going back to work. In the meantime, this dynamic will create the following. Number one, either wage inflation, where employers have to offer more incentives to get employees out of the house to work for them. But these incentives have to compete with government checks. Number two, if employees, regardless of the incentives, continue to choose to stay at home, then we will see weak jobs report in the next few months. What does that mean? It will be an excuse for Neel CASHkari and the Fed to say, you know what, we're getting bad jobs reports here. And we have millions of jobs that we have lost during the pandemic that we have not recovered yet. And therefore, we're not going to taper right now. We're going to wait till, quote unquote, full employment to happen. We're now hearing that the Biden administration is thinking about extending the so-called enhanced unemployment benefits beyond September due to Delta. And therefore, the expectations are, at least this is the argument from the buy the dip crowd, we're going to continue to see high numbers of unemployment in the next few months. This will prompt people like Neel CASHkari and the Fed to say, you know what, we're not going to taper now. There is a high risk for the economy to fall back and we start losing jobs. We're going to have to continue the cocaine operation, the quantitative easing, the so-called accommodative measures, the so-called emergency measures, until the employment picture improves. The problem is, so long as we have stimmies and unemployment benefits, along with the COVID conditions, the likelihood is we're going to continue to see a high number of unemployment for a long period of time. What does that mean? It means, and this is the argument of market bulls, the dip buyers, and the like, the Fed will not taper and the cocaine operation will go on
forever and ever and ever.
Anyhow, enough talking about this piece of shit, and let's move on to the market coverage and how the market performed today. And here we go. The Dow Industrial Average closing in the red, down 66.57 points, or a decline of 0.19%. The Nasdaq closing in the green by 15.87 points, or a gain of 0.11%. What about the S&P 500 closing in the green by 5.53 points, or a gain of 0.13%. The futures were down big, but the market managed to stage a so-called recovery, aka market manipulation. What about the different sectors of the market? What happened here? Number one, capturing the gold medal, technology. At number two for the silver, defensives. At number three for the bronze, utilities. Mind you, the performances are a little pathetic here. They closed barely in the green. Meanwhile, the laggards of the day led by energy, materials, and consumer cyclicals. What about the advance to decline ratio? We had a massive rebound, right? A great day. The market is performing. It's a bull market, yada, yada, yada. The NYSE, 26% advancing versus 72% declining. What a great performance. The Nasdaq, 28% advancing versus 69% declining. So while some of the indices closed in the green, under the hood, the internals, they look awful. Keep that in mind. Moving on to futures, what's going on here? With the exception of OJ closing in the green, everything else is down. The reason is the dollar shot up higher, and we're seeing a massacre in the commodities market. Crude down, lumber down, coffee down, cotton down, gold down, silver down, copper down, even lean hogs down. When it comes to grains, soybeans down, corn down, rough rice down, everything is down. And of course, this is welcome news for the Chinese. The Chinese have been attempting over and over and over again to push the commodities market down. And the reason is the Chinese, are the biggest consumers of commodities. High prices of commodities hurt the Chinese economy. Now we have the Chinese demand down due to shutdowns from Delta. And on top of that, we have the Chinese government also attempting to manipulate the commodities market down. We had news regarding iron, and iron prices went down big today, taking aluminum and steel prices down with it. So the commodities market got a double whammy today. Number one, the dollar shooting up higher. Number two, the Chinese manipulation of the commodities market. You see, when JP Morgan takes a break from manipulating the commodities market, the Chinese replace them right away and they start manipulating the market any way they want. Moving on to the big casino, the options market. What's going on here? The hottest table in the casino is Apple, per usual, at number one with about 1.2 million contracts. About 71% of those were calls. And here we have a number two, Nvidia, with about 1.1 million contracts. About 66.5% of those were calls. And at number three, we have Alibaba, down big today. We had about 600,000 contracts exchanging hands for Alibaba today in the casino. About 60% of those were calls. What about the unusual activities that took place in the options market today? Starting with the trades for the ticker SKLZ. This is for skills. It's a Wall Street Bets favorite. Kathy Wood kind of name. And here we have somebody making a bullish bet via a calendar call. They're buying the 11 calls with the expiration date of August 27th. Meanwhile, they're selling the same call, the 11 calls, with the expiration date of tomorrow, August 20th. The assumption is that SKLZ will not close above 11 by tomorrow, and therefore those call options will expire worthless. But next week, SKLZ will move higher past $11 a share, and this trade will be extremely profitable. They paid about 30 cents a piece for the August 27th expiration leg. Meanwhile, they received collected premium of about 15 cents a piece for the leg expiring tomorrow. All in all, the entry cost for this trade is about 15 cents, which brought the total all the way to about $250,000. What about the trade for the ticker M, Macy's? A couple of days ago, I showed you a trade for this name. Somebody bought calls for Macy's, and today we saw the name rising higher, double digits. There are many reasons, among them Amazon's announcement that they're going back to the brick-and-mortar retail stores. Now, they're going to have to buy some real estate space, and the assumption is Macy's holds a lot of space in these malls where Amazon is eyeing opening stores. But here we have somebody calling a top, betting that Macy's will start to trade down at least for the short term. They bought the 20 puts with the expiration date of next week, August 27th, with expectations that the name will drop by over 8% by then. They paid about 45 cents a piece to enter this trade. All in all, spending about $675,000. What about the trade for the ticker SPY for the S&P 500? They made a bearish bet here by buying the 415 puts, expiration date September 15th, with expectations that the SPY, the market, will go down by over 5.5% by then. They paid about $2.80 a piece to enter this trade. All in all, spending about $3.5 million. Now, we have the seasonality, the weakness of August and September in prior years at least. Therefore, we're seeing a lot of bets, a lot of hedges, a lot of insurance plays. Perhaps this is one of them in case the market goes down 5% or more. What about the ticker ATVI? This is for Activision Blizzard, aka the frat house. They're betting to the downside here by buying the 75 puts, expiration date October 15th, with expectations that the name will drop by over 11% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $1.5 million. What about the ticker OXY for Occidental Petroleum? Oil stocks, all of these gas stocks got whacked today. Massacre. But somebody's betting for a rebound at least for this name. They bought the 24 calls with the expiration date of October 15th, assuming that the name will go higher by over 9% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $1.2 million. What about the trade for the ticker BABA Alibaba? They continue to bet on rebounds over and over and over again, but they're catching a falling knife so far. Will this time around be a charm? Who knows? Anyhow, they bought the 170 calls, expiration date September 17th, with expectations that the name will rise higher by over 6% by then. They paid big bucks for this one, $6.50 a piece for this trade, bringing the total all the way to $5 million. Continuing with unusual activities in the options market. What about the ticker WM? This is for waste management. You see, instead of buying garbage stocks, how about you invest in garbage and you buy waste management? This was one of the picks that I had for the inflation trade, and it has been one of the best performers year to date. Somebody's betting for more gains to come for WM. They bought the 160 calls, expiration date September 17th. With expectations that the name will rise higher by over 5.5% by then. They paid about 60 cents a piece to enter this trade. All in all, spending about $360,000. What about the trade for the ticker ANF? This is Abercrombie and Fitch. Well, the good old days of tight shirts. Remember how tight the shirts were? And you had guys, shirtless guys with six packs dancing outside. You get in with the nightclub music and the perfume. Well, these days are over because in the woke era, it's offensive. It makes other people with different body shapes feel insecure, and therefore we have to cancel the fun for everybody else. Regardless, it seems like this strategy has been working for them, so God bless. And somebody's betting for more gains to come for the name. They bought the 40 calls, expiration date August 27th, with expectations that the name will rise higher by about 7% by then. They paid about $1.20 a piece to enter this trade. All in all, spending about $800,000. What about the trade for the ticker MARA? This is for Marathon Tulips. It's a proxy for Bitcoin and other cryptos. They're making a bullish bet here. Bitcoin moving higher today, and we have MARA also moving higher, and they're betting for more gains to come. They bought the 34 calls with the expiration date of August 27th, with expectations that the name will rise higher by over 7% by then, and they paid about $1.20 a piece to enter this trade, bringing the total to about $550,000. Lastly, what about the trade for the ticker IWM for the Russell 2000? What a shellacking the Russell has been getting as of late. The Nasdaq, the Dow Jones, the SPY, a little bit of weakness, but nothing major yet. The Russell is getting hit harder, and here we have somebody betting for more pain to come. They bought the 196 puts with the expiration date of October 15th, with expectations that the name will drop by over 7.5% by then. They paid about $3.75 a piece to enter this trade. All in all, spending about $1.5 million. Moving on to the heat map. What's going on here? Obviously, the inflation trade is not working at all. Financials down, industrials down, energy down, materials down, everything is down. The Chinese names are not performing today. Alibaba down, Pinduoduo down, JD down, the EV manufacturers down, NIO, Xpeng, Li, even Tesla down, and we have Toyota, even Toyota's down. And the reason is, in their earnings call, Toyota indicated that they're suffering from the chip shortage and expect delays here. We're hearing about delays from every single car manufacturer, whether it is about the Ford Maverick, the Ford Mach-E, Tesla Model 3, all being delayed. And now we have even Toyota confirming the delays. We also have weakness in the IPO names, the likes of Airbnb and Dash, all down big today. So what's working? What's working is a handful of names. Number one, Microsoft rising higher. Perhaps we called them out on Apple, and now they're switching the strategy from Apple to Microsoft. If you pump Microsoft, you can pump the SPY and the Qs alike. Not as good as Apple, but it works. Now, I happen to be a shareholder of Microsoft, and therefore I'm not minding the gains, but I do mind the manipulation efforts. What else? Nvidia off earnings rising higher. Likewise, Cisco also rising higher on the heels of earnings. But we have names like Netflix also rising higher out of the blue. And you might have heard the news yesterday about the SEC busting a ring of insider traders. There were some manipulation efforts and insider trading going on with the stock. I believe it was a former executive leaking the subscribers' numbers to other traders, and all in all, they made about $3 million in profits. Of course, the SEC is busting the little guy for making some money, but the big guy, the entire market, is being manipulated by the Fed every single day. How about we arrest Jerome Powell or Neel CASHkari? Anyhow, we have other names also working in the market today, like Regeneron. We got the news that the governor of Texas caught COVID, and apparently he says that he has no symptoms, but he is also using the Regeneron treatment. We also have names like United Health, the ticker UNH, also rising higher today, along with certain consumer defensive names, the likes of PepsiCo, Procter & Gamble, Costco, classic names, defensive names, outperforming today. Moving on to charts, the technical analysis, what's going on here, starting with the SPY 30 minutes chart. This is a line chart, by the way. We're back at the consolidation box, and it appears to be that the chart managed to bounce from 438. Yet when we switch to candles, you can see clearly that the chart gapped down in the morning all the way to the lower end of the consolidation box, and it managed to rebound from that point, which happens to be around 436. The chart recaptured the support of 438, retested that level twice, and now it is battling the upper end of the consolidation box. Now, you think this is a coincidence, by the way, or is the guy you're listening to right now understands charts and how algos work? You have other analysts over at YouTube saying, here's a line, here's another line, how about another line? And after 20 minutes, you realize that the guy talked nothing but gibberish. Here, we're giving you exact numbers to look out for. And in this case, we have the consolidation box borders. You have an upper border and a lower border. We have a breakout imminent one way or the other. Now, the assumption is we have option expiration tomorrow. We saw a lot of volatility in the market throughout the week, meaning lots of puts were bought. What happens when market makers sell those puts? If the puts are in the money by the expiration date, then they're going to have to buy the stock. On the other hand, what happens on the other side of the trade? The one who bought the put options for insurance, for a bet against the market, whatever the reasons may be, they're going to have to close these contracts. They're going to have to buy them back. The reason is you're not going to short the market right now. You might have bought puts, and now these puts are in the money. You're not going to exercise these puts and short the market, at least not right now. The risk is still to the upside, not the downside. So the likelihood is, the bias is that the market will trend higher tomorrow. Because even if you have puts that are not in the money right now, but perhaps close to the money, market makers want these puts to expire worthless, meaning they're going to start pumping the market higher in the morning. This is the assumption. I don't have any guarantees for you. What about the daily chart for the continuous contract on the SPY? I showed you the line, the trend line, yesterday, and I told you watch out for the line. Whether the chart will bounce and rebound from the line, the trend line in yellow, or will it break the trend line to the downside? And the chart decided to rebound to the penny from that line. Once again, you think this is a coincidence, or perhaps Jupiter was trending some way? No, this is how the algos work. Used to program algos. I know how they think. They're stupid, by the way, even if you do a good job in programming these algos. But I know how they think and what patterns they look for. Now, is the bounce change the sentiment at all? Not really. We're still trading above 3,384.5, which is the last support level. The chart is trading above that level right now. Yet we still have some negative divergences in the RSI and the MACD indicator, signaling that there is a weakness in momentum. But when you study the volume, for example, the majority of the volume came out early in the day, aka buying the dip. So the spike in volume happened to the upside. What does that mean? The bias, for now at least, is to the upside, for the rebound to continue. And we have options expiration tomorrow. They want to pump the market higher. Whether they're going to be successful or not, that's a different story, by the way. But the bias right out of the door is to the upside. Perhaps we will see a gap and crap, who knows? A pump and dump. All of these scenarios are possible. But for now, the bounce is holding, and the risk will start for this chart once the line is broken. Which line are we talking about here? We're talking about the yellow trend line. Once that's broken, then we got a problem, because the next destination of support will be 4,232, and this will be a steep correction all the way down. Moving on to the Qs, the Nasdaq. What's going on here? 30 minutes chart. We're using a line chart here. We had a descending line, a descending slope line of support that was violated, but we saw a rebound around 360.5, which was the support level, and the chart managed to climb all the way, reclaiming 363 for support once again. For more clarity, let's go back to a candlestick view, and you can see it clearly right away. Rebounding from 360.5, we opened gapping down, a massive rebound. The Coke hit right away, and the chart climbs above 363, almost to 365.5, but this was a strong resistance, at least for now. One way you can look at the chart is we have a higher low. We opened down at 360.5, rebounding all the way to 365.5, and then pulling back, catching the support from the same trend line, the slope, and then bouncing higher all the way to 365.5 once again. In the process, creating a higher low. So for now, the bias, at least in the morning, is to the upside. Now, every scenario is possible. The market could be gapping down right now as I'm speaking. Yet the bias off the door in the morning will be to the upside. Number one, you have shorts covering and taking profits. Number two, you have market makers having to buy the dip via exercising the put options they sold, and then you have the retailers, traders who bought put options, and now they have to close these put options because exercising these options and shorting the market right now is quite suicidal. So you have three dynamics pushing the bias and the risk to the upside. Here's a daily chart for the continuous contract of the Nasdaq. Rebound day, but failing to close above 15,000. The weakness remains in the momentum indicators, the RSI and the MACD indicator. But again, the bias right out of the door will be to the upside. Now, could we see a gap and crap? Could we see a reversal? Could we see a pump and dump? We'll talk about that as we trade tomorrow. But for now, understand that the bias is to the upside. You also have the volume spiking higher, meaning that we saw some short covering in the morning, profit taking. Will that continue tomorrow? The assumption is yes, at least in the morning. What about the IWM 30 minutes chart? We had a harsh rejection from 218, prompting the chart to go down all the way to the next support of 212. The chart went back and forth around 212, closing slightly below the number. We're not going to make a big deal out of 211.97 closing. It missed it by about 3 pennies. But the weakness is evident. Are we going to see some short covering on Friday? Perhaps. The assumption is yes. We will see some short covering in the morning. We will see some market makers buying the IWM. Similar story with SPY, Qs, and individual stocks. The bias is to the upside. But we got a problem here with the US dollar shooting higher, trading way above 92, 93, and now heading to 94. A higher US dollar is not good for the market. Simple as that. So while the bias might be to the upside due to the options expiration date, we have certain forces that could push the market to the downside. Among them, the spike in the US dollar. We're now eyeing 94.5 if this impulsive rally continues in the US dollar. Now, I gotta be honest with you. My gut feeling is we're gonna have buy the rumor, sell the news in the US dollar. What do I mean by that? The dollar is moving higher due to tapering expectations. But once the tapering is actually announced, my gut says the dollar will reverse and trade down. Just a gut feeling here. No evidence, scientific or otherwise. But remember, we have the Christopher Nolan pattern, a cup and handle within a cup and handle. This is a powerful pattern that could easily spike the US dollar all the way to 95 even, not just 94.5. Of course, the rise of the US dollar created a massacre in the commodities market, specifically for metals. Copper happens to have the highest degree of sensitivity with the US dollar. The dollar moving higher, crushing the price of copper and related stocks, the likes of FCX, Freeport-McMoran. In addition, we have aluminum, iron, steel, platinum, palladium, all trading down due to the rise of the United States dollar. But gold, perhaps the most important precious metal, is holding ground for now. Remember, gold is the mature guy in the room. So far, it has been holding ground, perhaps calling a bluff in the move in the US dollar. But my 2 cents say gold has 3 enemies, 2 major ones, 1 minor. The major ones, the Dixie and yields. The minor one is BTC. Bitcoin. While the Dixie is popping higher, yields are crashing, so we have 1 enemy down here. Likewise, BTC moving higher, but stabilizing, not impulsive movements at all like we saw the last couple of weeks. So for now, gold is holding ground. But if yields start to move higher, the assumption is they will not, but if they do, then gold will be in the scenario of the double whammy. This is the challenge that gold investors have to go through. You are in one team, but you're fighting 3 enemies. And this makes investing in gold challenging, but also unattractive. The 10-year yield, what's going on here? Pulling away from 1.28%. This is the threshold, and we're waiting for a closing, a weekly closing, above or below 1.28%. The preference is that we're going to have a defined closing, a strong, no doubt at all closing above or below 1.28%. This will serve as a guideline for us to trade the upcoming week. What about the TLT trading above 149, the important threshold? 149 in the TLT is the equivalent of 1.28% in yields. A weekly closing above 149 will imply that the TLT is not finished moving higher. On the other hand, a weekly closing, a strong one, a decisive one, below 149 will indicate that perhaps yields have bottomed and they will start moving higher, therefore the TLT topping. I doubt that this is the scenario that we will get tomorrow, but expect the unexpected. What about the VIX? What's going on here? Massive pop. This is a 4-hour chart, by the way. Again, we have a reliable indicator in the MACD indicator. Every time we have a positive crossing, creating green impressions in the histogram, that was accompanied by at least double-digit gains in the VIX. This pop felt a little different from the beginning. From the get-go, the MACD indicator spent a lot of time gathering energy, trading to the downside, melting down, but I told you this is a bull trap because when the VIX goes down, the market goes higher. This was the coil spring we've been talking about for a while now, resulting in a massive pop higher, going all the way to 25, almost, before reversing all the way down to 20. The most important take here is a weekly closing above 20. The VIX closing the week above 20 will mean a lot of pain for the market is about to come. Look at the MACD indicator, by the way. Does it look like the move is topping? Perhaps. We saw reversals from that level before. But are we seeing curling down in the VIX? No. At least not for now. So the assumption is the VIX will continue to pop higher until and unless we see the MACD indicator curling down and the VIX closing below 20. Tesla, what's going on here? 30 minutes chart. We have AI Day. The culties rejoice. Reverend Elon Musk is revealing whatever he's revealing right now, the revelations of AI Day. Perhaps the tickets to heaven is being distributed right now, also known as the cyanide. But back to the charts, Tesla violated 679 as support, and we have somewhat of a bear flag formation here. The threshold remains a weekly closing above or below 679. Above will be a bullish signal, below will be a bearish signal. Now, the reaction, if history is correct, if it's going to rhyme, that we have battery day and automation day and robots day, all of these were hypes, pumps and dumps, and nothing tangible came out of these events at all. Remember the robo-taxis in 2019? We're going to get robo-taxis in 2019. The streets will be filled by robo-taxis. Where are the robo-taxis, Reverend Elon? But anyhow, the man makes promises, empty promises, who cares? The culties get excited and they buy the stock. We will see if they're able to push it higher. But for now, from a chart's perspective, the bias is to the downside, at least when we follow previous events, the likes of Battery Day and the bear flag formation. It's a small one, not a big one, not a major bear flag, but it is a bearish formation. The chart, after all, violated the 679 threshold, which is an important critical level to keep for any bullish scenario to blossom. What about Apple? What's going on here? 30 minutes chart. Still trading within range, defending the 145 support line and rebounding higher. Is this bullish behavior? Is it a bearish behavior? It is a neutral behavior. It tells you that the chart is still trading within range. The chart is not ready to break one way or the other, up or down. And this is the leading indicator, at least for me. A break below 145 will be a signal to short the market. A break above 150 will be a confirmation that we have higher highs to come in the market, S&P 500 and the NASDAQ. Lastly, what about AMC? This is a 30 minutes chart. I gave you the number last night. What was the number? 37. 37 had the highest open interest for the expiration date of tomorrow. I told you the market makers, the hedgies and the likes, you hear me, apes? They're going to try to push the stock below 37, because if the stock closes above 37 today, had it closed above 37, we would have seen a gamma squeeze, a mini small gamma squeeze, but it would have been powerful anyways, perhaps pushing AMC all the way to 40, even 45. In the pre-market, I was watching the behavior of the chart. And every time the chart traded above 37, it was pushed down right away. This behavior told me that the selling pressure is a lot stronger than the buying pressure. And therefore, when we saw the flush down in the morning and the stock was trading at 35, I exited the position that I had. I got in at 32 and I got out at 35, but I also sold some call options for a high premium. All in all, it's an okay trade. It's not a lousy one. It's not a great one either, but it is an okay trade, at least when you consider the volatility in the market this week. Unless the apes are able to push the stock higher above 37, it's going to be difficult to see any gamma squeezes happening tomorrow. And with that, ladies and gentlemen, let's move on to the conclusion of this video. I know you're tired already from hearing me talk over and over and over again. I'm tired too, by the way. But what do we have on the economic calendar tomorrow? Nothing. We have Bob Kaplan of the Dallas Fed Reserve Bank, whatever it is, speaking. Now, we know that Kaplan is quote-unquote a hawk. And by hawk, they mean honest, telling the truth. So we know what Kaplan, aka the chairman, by the way, because he likes chairs, we know what he's going to say. No surprises at all. The surprise will be if Kaplan turns dovish. For whatever reason, they held his balls in a basement somewhere, and now he turns dovish. That will be a surprise. A pleasant surprise for the market. But otherwise, nothing new here. The main event remains options expiration. For a moment tomorrow, the market will be divorced from tapering, Afghanistan, China, lizards, whatever it is. The market will be concentrating on cleaning house for options expiration. So expect some volatility here, big time, at the opening and the closing of the day. Anyhow, folks, I'm tapped out here. Thank you for listening. Thank you for watching. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.